Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. So find out why and get instant access to his #1 gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using the same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. So to get a copy of his new free report with all the details, simply go to 2022goldmania.com. Again, that's 2022goldmania.com for a free copy of his new report. What a pleasure being here in Zurich at the Swiss Mining Institute with Otavio Costa. It's a pleasure meeting you finally after following your work for so long. How are you enjoying Zurich?
Doing very well, and glad to also have the opportunity to talk to you.
Yeah. Well, like I said, I've been following your work for quite some time, and and two things I really want to talk about with you today. You've written a lot about the decoupling that we're experiencing now between the Nasdaq versus commodities. Let's start by talking about what you're seeing in the market right now.
I think it all goes back to valuation proposition of technology companies and growth companies, long duration businesses. They're all extremely expensive, and by almost any metric you look at fundamentally compared to natural resource industries. And so I think the decoupling is now coming along as cost of capital is starting to rise, and so investors start looking at profitability rather than growth. And I think the last decade or so, we've seen a lot of folks chasing growth only. And now finally, with margins getting squeezed by inflation, so you have labor costs, energy costs, and especially costs of capital. So now it's forcing folks to really, can they really justify those absurd valuations we've had in technology companies? And so that's why I'm seeing that decoupling being very interesting, that there's a lot of changes in correlations right now that I think are being caused by those shifts, structurally changes in inflation and so forth.
Does the tech industry rebound?
Well, I think there's a lot more to go on the downside. And the reason for that is just looking at historically when the pendulum starts to shift. I think that's a long-term trend. I personally believe this is, I call it a trifecta of macro imbalances because we like to compare with other times in history, but really, you can really go back 120 years. This is very unique what's going on, meaning the speculative environment that we have sounds like the 90s, the late 90s.
Yeah.
But the late 90s didn't have the debt that we have. It also didn't have the inflation problem either. And so I think that's the unique side of it. Personally, I think there's going to be a lot of reckoning, especially in long duration assets. I think rates have more to go. Interest rates have more to go upside, especially long term, globally too. And so that's going to cause that cost of capital trend along with the change in re-rating of prices of technology companies. So I'm a lot more bearish than I would say the average guy.
Really? So I mean, we've already seen the S&P under tremendous pressure, but you think there's a lot more pain ahead?
I do. I think we're going to shift a little bit from, we've seen the valuation side started back in February of 2021, which ARK, I think, hit a peak there back then. And then since then, we've seen software stocks. If you look at the profitability, number of companies that are profitable in the software space, one of the lowest amounts in history. And what you find there is that the majority of those companies has started going down much first than, I guess, much earlier than the other side of the market. I think the next lag is going to be the larger companies where I believe we're going to see some kind of labor unionization, meaning large companies that hire a lot of folks will have pressure from labor markets.
So like Amazon,
yes,
Target, Walmart.
Correct. Especially the ones that have very large amounts of employees. And I think, again, particularly the technology-related companies, put Apple into that, which is Amazon, Google, and so forth, and Facebook, Netflix. I think all of those are going to suffer that. But there's another side of it, which is consumer discretionary companies and companies that have very thin margins already. I think we're going to see some squeeze of margins. And so a lot of opportunities on the short side to hedge your long commodity side. So
would you say a complete implosion of the S&P market? I mean, how severe does it get?
I don't have that crystal ball to know if we're going to see an implosion. But historically, every time we reach levels of valuations that we have today, now one way I like to look at is the 5-year cyclically adjusted earnings yield. And it's basically you looking at the Professor Robert Shiller's CAPE ratio, shortened it up by 5 years rather than 10, and looking at a yield basis. And today we're just as expensive as we were back in 1937 and 1929, before the 1929 crash. So usually we see some major declines from here. And so I believe that we can see certainly a reckoning moment in equity markets.
So let's talk about your main thesis, which is like time to buy commodities, get out of equities. Why so bullish on commodities?
Look, I think that if you look back in other inflationary environments like the 1970s and 1910s, even the 40s, one of the things you find in common is that rates are deeply negative in real terms. And the second thing you find is that tangible assets actually outperform financial assets. And today, with financial assets in a much larger, problem when it comes to valuations relative to those times, speculative environment is way worse than it was in the 10s, the 40s, and the 70s. I would think that the commodities to equity ratio would be a much more attractive investment than it was back in those days. But the one thing that we found in common during those inflationary decades is how tangible assets tend to perform very well. And so I think they're going to play a key role into becoming more and more of inflationary hedges for portfolios. And if you really think about portfolio positioning, not a lot of folks really have been allocating capital towards gold, silver, copper, oil. Just now we're seeing that shift, but there's a lot more to go.
I remember when kind of the cryptos emerged or getting red hot, there was so much talk of money flowing out of gold into Bitcoin.
Yeah.
Are we seeing any reversal of that? Are you seeing any of that shift taking place?
I think my opinion about crypto is that it's an extension of the technology sector, meaning it's certainly been chasing very similar types of investors. I think some of that will actually flow into gold and silver at some point. We haven't seen much of that, and I think gold and silver have been kind of suffering through this tightening cycle we're seeing. How much can the Fed really do is the question. I don't think they can do much. Eventually, we may see a reversal, and that's what's going to be interesting.
Why do you say that the Fed can't do much?
Well, it's just the trifecta of imbalances. I mean, you can't really do much. I think policymakers are really constrained when you have a speculative environment in terms of valuations of financial assets. On top of you got inflation, and then on top of it, you have the debt problem. And so how much can they really raise rates? It's policy making is really constrained from almost any side, especially monetary. And so I think that they can only raise rates so much. I mean, right now, we're just so far away that it's okay that they're being able to raise rates. But for how long, it's a real question. And so if you think about 10-year yields, right now they've been rising. For how long can they really rise? I mean, can they reach 4 or 5%? I think the Fed members are going to be very vocal about yield curve control and things like that. But I think that's inevitable, personally.
So we're obviously here at a mining conference in Zurich. Let's talk about opportunities in the precious metal sector. Where do you see the greatest?
I would say that the majority of our capital has been really allocated. I would say 50% of our allocation has been in metals, 20 to 25% in energy, 20% has been in agricultural commodities. The metal side is really a lot of exploration assets. So we love gold, silver, and base metals. Silver in particular is very hard to find good assets. I think there's a lot of great companies in this conference. I guess I'm kind of biased because we do invest in a lot of them here, but it's actually a great conference. I mean, there's a lot of good opportunities in my opinion. We've seen some interesting names that we don't own yet, and certainly interested in hopefully doing an investment here soon.
Yeah, offline we were talking about risk reward and how you felt maybe before mining companies were rewarded better than we are today. Why do you say that?
Well, I think we all can see the capital trend as far as how much money has gone to technology in terms of capex versus natural resources.
Yeah.
But one thing that nobody looks at is the labor trend. And the labor trend ties to why I think the exploration is such a good opportunity, because exploration is the side of the industry, number one, that most of the billionaires in the industry make money in exploration.
Absolutely.
And number two, it requires a lot of technical knowledge.
Yes.
And we don't have technical knowledge nowadays. I mean, there's a lack of that. And so if you find someone who has the professional expertise to navigate the space, basically you're finding a lot of inefficiencies. Inefficiencies are things that investors should be chasing. And so most of the capital now chasing institutional capital when it comes into the space goes first to the companies that have consistent free cash flow, because it's easier to make the analysis. Developers, you got a lot of financially savvy folks doing analysis on those. Exploration is different. You need geology expertise. And so
that's a bit of a mind shift. Chase inefficiencies.
Yeah.
Right?
Yeah.
Because you would think do the opposite, but you're saying no, chase the inefficiency. That's where the greatest opportunity lies.
I think you're looking for probability statistically of large or world-class discoveries that are just not priced in the market right now. And so certainly I would say a lot of drill results, as we were saying before, a lot of drill results that are being reported today, if they were being reported back in other gold cycles, companies would be up 3x,
right?
But they're going up 20, 30%. So if you're a long-term shareholder, that's great. I mean, just take advantage of that. So we've been doing, accumulating assets in the space. I don't know when it's going to shift, but meaning when capital is going to flow into this part of the industry. But knowing that the majors are facing a gold and silver supply cliff problem, and a lot of the majors are facing that, I would think that as balance sheets are improving drastically with free cash flow growth that we've never seen before in this industry, I think we're going to see a major M&A cycle like we've never seen before.
Wow.
And so, yeah, I'm very long-term bullish in this space.
And that's healthy.
Very healthy. I think we've gone, if you think about how companies have been forced to attract capital from institutions, what they have been doing is they have been doing a lot of shareholder friendly types of policies, meaning buybacks and dividends. So if you look at both in aggregate, they're almost doing as much as what they do in capex today. So they're basically giving back capital to shareholders to almost the same degree as they are investing in their own businesses. We've never seen this before. And so this is a record amount of extreme conservatism that on top of the political constraint or the political effort on ESG policies and so forth, is really constraining companies to produce, but also to invest in exploration. So most companies are focused on free cash flow. How do I generate free cash flow short, medium term? And not too many people are focusing on exploration. So I think it's a great time to be invested there. Yeah.
Tavi, bring it home for us. Final thoughts for viewers watching.
Final thoughts. Well, I think this is a risky, there's a lot of opportunities, but there's a lot of risky parts of the market today as far as the overall equity market. And you've seen the commodities to equity ratio. I think that's the most important chart everyone should be looking at. And if you're an investor and you're able to be long inflationary assets and hedge that position by being short a lot of long duration assets and very overvalued names, I think you're going to be in a good position of that spread trade of tangible versus financial assets to work over time in the next 5 to 10 years. Literally, it's a very long-term play. And so asymmetrically, I think you want to be looking for exploration assets and places where you can find a lot of inefficiencies. That's what we are doing, but I think there's a lot of great opportunities out there.
Tavi Costa, thank you so much.
My pleasure. Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.